Hi everyone, this is David from the IFRS base. Welcome back to our Back to Basics series where we break down accounting into the simple, fundamental concepts. Today we'll be discussing the accounting trinity: assets, liabilities and equity that are the backbone of each and every financial statement, especially the statement of financial position, or how it is usually called, the balance sheet. Let's begin our discussion with the definition of the asset. An asset is a present economic resource controlled by the entity as a result of past events. Basically, the asset could be cash at the bank, the building owned by the entity, and any goods that the company owns and is going to sell in the future. At first glance, it could look quite simple, but even experienced professionals sometimes struggle to identify the asset, and the reason is the lack of fundamental understanding of the definition. Therefore, we will cover each and every part of the definition separately to understand the logic behind it. Let's begin with the present economic resource. The conceptual framework under IFRS, International Financial Reporting Standards, defines it as a right that has potential to produce economic benefits. Right can take many forms. For example, the right to receive cash called receivable, the right to receive goods called prepayment. Economic benefits could be produced by entitling the entity to receive cash flows or another economic resources. It does not have to be certain, or even highly probable, for the right to exist. The probability could affect other aspects of financial reporting that are not subject to our discussion in this series. Control. An entity controls an economic resource if it has the present ability to direct the use of the economic resource and obtain the economic benefits that may flow from it. For example, entity purchased some materials for the purpose of producing the phones, so the entity has the ability to directly use this materials in the production process and obtain the economic benefits associated with it. This part of the definition is actually self-definitive and refers to the fact that asset is owned by the entity as a result of the financial transaction in the past. For example, acquisition of the building or cash received as a result of loan provided by the bank. We are moving to the second element of the Trinity, liability. Liability is a present obligation of the entity to transfer an economic resource as a result of past events. Let's now dig into this criteria as well. An obligation is a duty or responsibility that the entity has no practical ability to avoid. For example, amount owed to the bank or trade payable to the suppliers for the delivery of goods. An entity has a contractual obligation toward the bank and suppliers in both cases. It is important to note that if one party has an obligation to transfer an economic resource, it follows that another party, or parties, has a right to receive that economic resource. So, the liability for the entity towards the bank represents the asset from the bank's perspective, usually called loans to customers, as it has the right to receive the cash from the entity, on the other hand. The second criterion for a liability is that the obligation is to transfer an economic resource. To refer to previous example, the entity has the obligation to transfer economic resource in form of repayments made on the loan. The third criterion for a liability is that the obligation is a present obligation that exists as a result of past events. In the example of the bank, the entity has received a cash from the bank in the form of the loan in the first place, and that was the past event that triggered the liability recognition. Respectively, an entity has obtained economic benefit in form of cash and will have to repay it back in the future. If the entity would not take cash in the first place, it would not otherwise had to transfer it. And the final element of the Trinity, equity. Basically, equity is the residual interest in the assets of the entity after deducting all its liabilities. Meaning that the claims against the entity that do not meet definition of liability are equity. The most common form of equity are the contributions of the owners that invest in the business. Hope this helped you catch the logic behind the key concepts. Understanding accounting might seem daunting at first, but every small step you take builds a strong foundation. Don't forget to like, subscribe, and hit the bell button so you won't miss the next episode in our Back to Basics series.